Definitely a very interesting day for markets today. We saw a pretty aggressive sell-off in megacap tech and the broader market, but this channel was up well over 3% for most of the day. And what makes us win? Well, we're positioned very strongly in energy stocks. However, we don't want to say that we're a godly people over here on this channel. We acknowledge the reality, and we faced a harsh reality for several weeks as energy stocks sold off and the megacap tech rally just continued. So being practical and honest, we have to say not everything's 100% for us over here, even though we are winning on a day like today. But I think this trend's likely to continue. Energy stocks are likely to continue doing very well. And there's a bunch of reasons for this, and we'll address the tech decline and why that may continue. So why are we so bullish on energy stocks, and why are we going to continue, hopefully, likely, we'll see, to see gains? One of the reasons is, the most fundamental and overlying reason is, US energy companies have had a complete paradigm shift from what they do with their money. In the past, they've gotten money and they've invested in new production. They wanted to grow their business, grow their total output. Now we're in a different environment. Shareholders say, we understand the world will one day not be reliant on oil, so we want to get our money now. Give us the cash now, put this money in our pockets. We're sticking with you, but we still expect a positive ROI, so we need that money now. That means US producers aren't engaging in drilling. They're not growing their production, and they took a lot of that production capacity offline when Corona hit. We all remember negative $37 a barrel. Almost half of that production hasn't come online, and honestly, likely never will. The next force is OPEC. So US production is capped. OPEC, they can do whatever they want, right? Well, we have some very strong insights today with the shortest ever meeting in OPEC history, 25 minutes. These meetings span for a very long period of time. If you remember when oil was close to its previous peak in the mid 70s, there was a very prolonged OPEC meeting where they ended up sticking with the agreement that they had at the very beginning of the meeting, but it took a while because there was a little bit of infighting. $400,000 a day additional meeting. OPEC just had its fastest meeting. And at the end of last week, we saw for the second time the United States attempt to talk to Saudi Arabia and ask them to increase production. That was followed by the fastest meeting in OPEC history in which nothing happened. So OPEC is happy to have prices up here and not increase production. So it seems like the bottom line is production isn't going to increase. However, energy demand is at record highs, above pre-corona highs, despite flights still not picking up full levels, and despite various, just conditionings to stay home around the world. Overall, not 100% mindset return. Yet, energy production is higher than it's ever been. So we should expect that as the world continues to open and economies continue to recover and expand, that consumption is going to increase. In addition, we're seeing what's happening with the natural gas issue throughout the world. It's a crisis that we discussed could happen on this channel, but not nearly to this level. It is blowing us away. Clearly, nobody, at least as far as I'm concerned, but I do know people who last year were talking about a natural gas crisis, saw it getting to these levels, and the winter hasn't even started. We can see that there's serious problems in Europe, where they're very dependent on wind energy, and there's not enough wind. So there's a deficit there, in addition to higher than normal energy consumption. So what's going to happen here is that because natural gas prices are getting so high and coal prices are getting so high, they're going to start using oil for electricity. This hasn't been occurring nearly as much as it could or has happened, but will likely begin to occur now. So Oil is definitely up, but it looks like we're gonna have a little more to go. Now, when oil goes up, it positively affects stocks like Exxon, Schlumberger, the OIH ETF, the XLE, Chevron, you name it, they're very much correlated with oil. So, given all of these macro forces surrounding the energy complex that seem to not be yielding negative results, but be yielding positive results, we should expect these stocks to continue to rise throughout the winter and likely for the foreseeable future until we see some sort of macro impact from renewable energy on the industry, besides just causing investors to sell stocks. So that's energy. Now tech taking a hit today. And the way we're positioned on this channel with regards to tech, because if you look at the stocks that have been made on, or the videos that have been made rather, on individual stocks, they are all tech stocks, two of which I still have holdings in, one of which I still have a substitute for, the CRISPR. I'm no longer a holder of CRISPR Therapeutics, solely given their above competition valuation compared to Editas. We still like some tech stocks, okay? I'm not gonna destroy all tech. I have this fundamental thesis that yes, rising rates impact long-term cash flow. Yes, inflation may have historically impacted tech stocks, but personally I don't subscribe to that because I think inflation has lifted all boats, but time will tell. We will know in hindsight. So the tech stocks I still have exposure to are ones that I think will have a very high growth rate, because if your growth rate is high enough, you should be able to overcome any sort of negative forces. So we're remaining in these types of tech stocks. However, the mega cap tech stocks, of which mainstream Wall Street people call growth stocks, are not featured in our portfolio. Many investors have believed that mega cap tech has been growth because they, in all fairness to them, do grow their earnings quite substantially. Amazon, Apple, Facebook, Google, etc. are all growing. But what we define a growth stock as is one that has the potential to 10x, see real, significant, transformative growth in their current business. Something that differentiates Amazon from Walmart, for example, because Walmart is also growing its earnings, but we don't call Walmart a growth stock. We call it Walmart, a blue chip. In my opinion, the mega caps are in that category, however, have been priced as if they are going to 10x. They have been given very generous multiples, and there may need to be some correction in that area of the market to give them more market appropriate multiples. However, we're starting to see that, and bond yields, rising bond yields may be the force that triggers it to its full extent. So I think this force needs to happen, should happen, seems like is happening, and may or may not continue to happen. But I see some valuation reasons as for why it should happen. So we don't have exposure there. Those are my thoughts about those stocks, energy stocks. At the end of the day, it comes down to multiple and price. So, multiple and price is very attractive in the energy sector, and their earnings are likely to continue to increase. We recently heard Schlumberger CEO talk about how they expect margins and cash flow to materially improve in the near and medium term future, not the long term. We know what's happening with energy. We know it's gonna not be here forever. But it gets hated on a lot, and it gets hated on possibly too much. So we're doing that. So until next time, peace out.